Hello, everybody. Ed Yardeni here. I'm here with my colleagues, Eric and Jackie. Jackie, thanks for joining us today. We want to talk about quite a few things, so we'll dispense with the usual discussion about chatter about the weather and get right into our topics. We want to talk certainly about the U.S. economy. There were a lot of very important upward revisions that occurred on Friday. More real GDP than initially estimated, more gross domestic income, more personal savings, a higher savings rate. And the conclusion may very well be that when we get the next productivity numbers, they'll be revised upwards as well. So we're obviously pleased with all those numbers since we've been in the no landing camp, sometimes soft landing, but more often than not, concluding that there's been no landing. We also need to talk about China, and Jackie's been doing a lot of work on that. She wrote about that again on Thursday. And Jackie, a question I guess is in everybody's mind is now that the stock market over there has gone straight up, copper prices have recovered as a result of all the announcement of, I guess people are calling it the whatever it takes program, kind of the Mario Draghi approach to just aiming a bazooka at the economy and trying to revive it. So, Jackie, everybody knows why the market is up and why all the stimulus is being discounted in a very happy way. Tell us about whether this is all going to bring the consumer back. What's the pluses and minuses for the consumer? Because that clearly is the heart of the problem there and the consumer's issue with property. So give us a couple of thoughts on that.
Sure. I mean, they've definitely unloaded a lot of stimulus, most recently with their willingness to let consumers refinance their mortgages. So, that obviously is a positive, but there are some things that we've looked at that are also negative that haven't been highlighted in recent days. And that is the fact that a lot of consumers still have, there's this huge property market and there's still a lot of inventory that's on the market. And the question is, when will that inventory be absorbed so that consumers see one of their largest assets start to appreciate again instead of depreciate? And the other item that we highlighted last week was the fact that the government increased the retirement age. So, that can't really make consumers too happy and might lead them to want to save some more, as well as, not free up jobs that older folks will stay in for younger folks who need new jobs. So those are some of the pluses and minuses.
Yeah, what's the retirement age going up to?
It increased. There are various different ages depending on whether you're in white collar jobs or blue collar jobs, but in general, they increased it by about 3 years for both men and women.
Oh, okay. That's depressing if you're thinking about retiring. The positive, of course, is they're kind of offering everybody the opportunity to refinance their mortgages at lower rates, correct?
Yeah, definitely. And with the 10-year bond over there very low, that should be helpful.
Yeah. All right. So, what about the business climate? Is that changing at all, or are there still some adverse vibes coming from the government when it comes to trying to be an entrepreneur or a capitalist in an authoritarian government?
Yes, again, they send these mixed signals where they're increasing the capital potentially that's available through the banking system. But then on the other hand, they'll do something like threaten to put PVH on the blacklist because they won't buy cotton from the Western region. Now, of course, that's problematic because the US government won't let you import cotton from that region if there's any potential that it's being made with forced labor of the Muslim population. So again, it puts these corporations in a very tough place. And then the Wall Street Journal reported last week that there was an economist who spoke ill of Xi Jinping's policies, and he hasn't been heard of since last spring. So that doesn't exactly encourage CEOs to come, invest in China. And
Yeah.
so we were looking at some of the foreign direct investment into the country. And while it peaked at something like 90 billion last year, it's been negative for the past 2 quarters.
How
So these
about
are
how
conflicting
about
signals.
go ahead, finish up.
No, just there are conflicting signals that the country is sending.
Yeah. What about the fiscal side? I mean, most of the measures were either monetary or credit stimuluses. Are we still waiting for a lot more on the fiscal side? I guess the Politburo was meeting, and they might decide to do something fiscally.
Yeah, I think that everyone's waiting to see if they're going to help out their local governments that have a lot of debt outstanding. And they really need to get this restructuring done in the private sector for their real estate development companies that are under a lot of debt.
Right, right. Well, we have seen the stock market move substantially higher, and the the real estate stocks have had a tremendous rally, and copper's gone up. I'm kind of scratching my head on why copper's up because I don't see that the aim of the government is to stimulate a lot more construction of apartments. They got more than they need. So I'm not sure that all the stimulus is going to suddenly lead to a big demand for copper piping for plumbing in Chinese apartments. But I guess I think some of this rebound obviously is short covering the perception that China is structurally depressed and isn't going to come back, and suddenly all those shorts had to cover. But I guess our bottom line is we're kind of skeptical, but clearly something has changed in a pretty dramatic way. The government responding. I think this is also sort of a political response because you've had, people from the United States like Treasury Secretary Yellen and people from Europe going over to China and complaining about them dumping goods in global markets and saying, why don't you do something to stimulate your consumers? So now, if anybody goes over there and complains, they can say, we're trying our best to stimulate the consumers, and if that works, then we won't be dumping goods in global markets. But I don't know that that'll change much. I think they're still going to be selling a lot of electric vehicles and appliances and everything else at cut rate prices because that's what they do. And so that may very well continue to create some deflationary pressures. But clearly, this changes the short-term situation for China. I'm not convinced that it changes the situation for commodity prices. There seems to be so much oil around there that maybe a stimulus package in China doesn't seem to have much impact. The Saudis are talking about producing more oil, but we just really didn't see oil prices surge on the idea that suddenly China's going to do better. Thanks, Jackie. Anything else you wanted to cap off with?
Nope. Again, we just have a skeptical glance at the property developers, but things do look a little bit better for the consumer.
Okay, thanks a lot. Stay with us, but put your audio on quiet and let's Eric. I guess the last week we felt was a pretty good week for us. I wouldn't want to be what we've called fondly, of course, and with all due respect, we've called them die-hard hardlanders, people who just can't get over the idea that the economy has to fall into recession. There were quite a few of them in 2022 and 2023. There were fewer of them in 2024, but nonetheless, they were the ones that were left were pretty vocal that it was going to happen. And as a matter of fact, one of the pessimists on September 25th wrote a very logical, convincing piece that with personal savings rate down so hard in the United States, that it was sort of a ticking time bomb, is the way he described it, that there wasn't really any room for the consumer to continue to consume by cutting their savings rate. And then the next day, the Bureau of Economic Analysis revises the savings rate up quite substantially. So that story sort of lost some of its credibility. And then the other story was that gross domestic income is much weaker than GDP. Generally speaking, they should be equal. There's this, what they call a statistical discrepancy, and it's usually pretty small. But it's been widening of late with GDP stronger than GDI, and the pessimists have been saying, well, the GDI is the more relevant statistic. It's more realistic with what's going on, and GDP should be revised down. And much to their chagrin, the BEA went the other way and actually revised GDI up. They didn't really revise GDP up much on a quarter-to-quarter basis, but on their benchmark revision, there was an upward revision, which we think could have an impact on productivity. Eric, you want to add anything before we get into the charts?
Yeah, I think it's just notable after the payroll revision specifically, a lot of people thought that output would then be revised lower. But I think our story was it's more of a productivity story, like the same amount of output with less workers means you're being more productive. And that's kind of what these revisions showed through. And after GDI being revised so much higher, it's likely that productivity could have been even higher. So yeah, kind of just supportive of what we've been saying.
Well, you can tell we're a team because I just noticed we're all wearing blue today. So I guess we all got the blue memo. But let's go into the charts here, and I'll share my screen. So here we are, September 30th. How time flies when you're having fun. I remember New Year's just not that long ago, and before you know it, we're going to have another New Year's, and meanwhile, Halloween's coming, and September turned out to be not such a scary month after all, and it's hard to see what's going to particularly go wrong in October. But we just had a little discussion in the morning briefing about perma bears versus perma bulls. Have a read when you have a chance. But the basic concept is that if you have to be a perma bull or a perma bear, if you have to take sides, it makes more sense to side with the perma bulls because the economy tends to grow over time. There are recessions along the way. They don't last very long, or they're not that frequent. And recessions are generally associated with bear markets. And so from the S&P 500 point of view, you certainly didn't want to be in the market during the great crash. So there are times when it makes sense to be a perma bear or at least get out of the market. But really, since that awful experience, we've had other awful experiences, but they don't occur that often, and they tend to be reversed. And so we have had this upward trend in the S&P 500, which reflects earnings, which reflects the economy is growing. So take a look at that little write-up. This is just real GDP versus real GDI. If you take a magnifying glass, you'll see that real GDI is still a little bit below real GDP, but much less so than before the revisions. Here's that statistical discrepancy. And again, that's much less. I think we're down to 0.3%. So real GDP and real GDI are only apart by 0.3%. So that's nothing to get concerned about. Eric, tell us a little bit about why they revised up the GDP. What was the component that revised up and what impact that had on things like personal saving?
Yeah. So the big increase in GDI was compensation, which is everything from wages and salaries to government transfers. So if you were spending a lot and your income got revised up, therefore so did your saving. I think a lot of the consumer spending metrics, retail sales, etc., have pointed to a consumer that's spending a lot. The really big concern or the loud voices kind of pointing that were doomsayery, we're saying, okay, this consumer is spending too much, they don't have the income to support it, they've run out of excess savings. It's quite clear they did based on these revisions. A lot of people see the chart of cumulative excess savings from the pandemic and they say, oh my gosh, the consumer's out, like they ran out, they're exhausted very soon. That model uses uses a specific savings rate in the calculation. And if you tweak it to current savings rates, it actually looks like the consumer has plenty of savings still left over. So I would just be wary of some of the songs coming from that camp. Yeah.
Yeah. Then we also had corporate profits was revised slightly higher, all-time record high, corporate cash flow, all-time record high. I mean, these are huge numbers. We're talking about getting pretty close to $4 trillion at an annual rate in corporate cash flow. Everybody keeps looking at profits. Profits is just one component of corporate cash flow. There's this item called depreciation, which is a huge tax shelter that allows companies to accumulate or to earn a great deal, to keep a lot of what they earn. And so corporate cash flow is just a part of the corporate profits are just part of the corporate cash flow story. Then there's some more charts here on retained earnings. I mean, dividends are all-time record high. Retained earnings aren't at a record high, but they're almost there. And again, that accounts for corporate profits after tax being in record high territory. Let's put it that way. Meanwhile, the diehard hardliners aren't going to get any relief here in the third quarter. The Atlanta Fed's analysis shows that the latest numbers add up to 3.1% at an annual rate for the third quarter. Some of that is inventories, but all in all, the even final sales are holding up quite well. Let's see, where do we want to go with this, Eric? Real GDP versus, yeah. Why don't you tell us a little bit about the, we've been sort of conceding that we're in a rolling recession hitting different industries at different times, and we have observed that the goods industry, particularly retailers and manufacturing of consumer goods, had a real boom there coming out of the pandemic. There was a real buying binge. And then people stopped binging, but the demand for goods just went sideways in real terms. It didn't actually decline. So we call that a rolling recession. But then looking at the GDP data, what's the conclusion? Is there a rolling recession even in the goods sector?
Yeah, it seems like goods have held up, and there's a pretty notable divergence between what PMIs are telling you and what GDP is. I think it's another kind of soft data type of discrepancy. I also just kind of rehashing on the corporate cash flows point, because of the revision in corporate profits, the corporate profit margin was also revised higher to over 13.1%. So I know some people might have been worried that, increased compensation, perhaps unit labor costs were higher than we expected, but it's more than likely that productivity was even higher because profit margins expanded. So again, just sort of supporting the productivity story.
Yeah, so as you said, this chart just shows the MPMI, the manufacturing PMI versus the year-over-year percent change in real GDP goods. So we're kind of breaking GDP into goods versus services, and so you can see a really tight correlation between the MPMI and the growth rate on a year-over-year basis in real GDP goods. And then recently it's diverged. So this has been signaling another misleading indicator that we've been pointing to. It's suggesting that manufacturing is quite weak, but from a real GDP perspective, it's up. It's been up over 2%, really for the past several quarters. So that's not the case. And then here's another one: the leading economic indicators. We've been highlighting that it's misleading because it tends to be biased towards the goods economy. And sure enough, as you can see here, the year-over-year percent change in real GDP goods is highly correlated with leading indicators, or the other way around. Leading indicators it has been a good indicator, but almost really a coincident indicator rather than a leading one of the goods economy. But once again, this has been predicting a recession for a while, and the real GDP is just not cooperating. So this all gets back to the resilience of the economy. Economy is less interest rate sensitive and so on. So this raises the interesting question, Eric. Explain to me why the Fed's lowering interest rates here, why they do 50 and not 25. Why is there talk about them doing another maybe 50 over the rest of the year?
Yeah, I mean, I think it's twofold. On one hand, they have inflation is kind of near or almost at 2%, if depending on your look back. Waller mentioned using a 4-month annualized average. If you look on a 3-month basis, PCED is at 2%. So kind of mission accomplished, at least in the Fed's eyes. And, they know that in the past, unemployment starts to rise, it continues rising. And I think a lot of Fed officials kind of are aware of our story or support it in the sense that unemployment is rising from an ultra low level, largely due to new entrants. But I think they're just not willing to risk it. They already made one mistake with inflation. They're not willing to risk the idea of 5% unemployment and having two policy mistakes in such a short time frame.
But aren't they, this mission, they did, fortunately, nobody said mission accomplished at the Fed because that would be a jinx. But in effect, they've been saying that. And whatever happened to the super core inflation rate, Eric, remind us where that came from and why have we kind of forgotten about it?
Yeah, I believe it was last year, but Powell especially was talking about supercore as kind of the underlying inflation rate and how it, stripping out energy, food, stripping out housing, which is a lagging indicator, at least in terms of how it's calculated in CPI. Inflation was a little more subdued. It was on the right path, but now as headline metrics kind of fall closer to 2%. Supercore looks quite sticky. So the quote unquote underlying inflation that the Fed was pointing to actually doesn't look all that favorable for remaining at 2% over the long run. The Fed has a lot of tailwinds at their back. We had goods deflation. We continue to. Oil prices have been falling rapidly. Those aren't things that necessarily stick with you. You know what I mean? There's exogenous factors that can influence those prices. So yeah, I think we're a little worried. I think we've been calling for 2% for quite some time, and Ed has been for several years. But I think over the longer run, we're just a little worried that inflation pressures or risks of inflation pressures are tilted to the upside.
Well, the other thing is not only did they cut by 50 basis points, but they signaled pretty strongly in the summary of economic projections that they're going to keep going and that they want to make sure that the unemployment rate doesn't go up and they don't want to go. I mean, they didn't say it, but I think they might be alarmed if it gets all the way up to 4.5%. Remember when 4.5% was considered full employment? But the thing that strikes us as odd is there is an election coming up here, and we know that whether it's Harris or Trump, both of them have policy suggestions that are going to probably widen the deficits substantially and might even be somewhat inflationary. And yet, the Fed is acting as though politics doesn't matter, fiscal policy doesn't matter. I mean, they do have this mantra that, the Fed is independent. The Fed only focuses on monetary policy. The Fed doesn't get political. The Fed doesn't tell the fiscal authorities what to do. Well, that's all very well and fine. But they do have an econometric model in-house that clearly has to have variables reflecting what fiscal policy is doing. And Eric, you pointed out that they remember being burned by not recognizing that inflation was coming up. Well, and one of the reasons inflation really soared was because of excessively stimulative fiscal policy, creating this huge demand for goods and services, and the services was closed, so everybody bought goods, and so we had this huge price increase in durable goods, and supply chains were disrupted. And then, of course, we had all sorts of issues with regards to the pandemic's impact on rent inflation, which went up. So it seems to me the Fed's just being awfully woke, very reminiscent of what the Fed was like before they suddenly focused on bringing inflation down. But look, I've said it before. Our job is not to tell the Fed what to do; it's to anticipate what they're going to do. The mantra is "Don't fight the Fed," and the Fed seems to be quite committed here to lowering interest rates further, and that's fine with us in terms of the stock market. It just may cause a melt up, but we'll see how that goes. Eric, I'm not quite sure how I want to define a melt up, but maybe it's if the market one more time goes above our target, this time it's 5,800, maybe that's a melt up because that's clearly valuation getting even more stretched. Okay, Jackie, you're still with us. Let's see if there's any questions for Eric or myself, Jackie, with regards to issues of China. So let me open ourselves up here. Eric, go ahead.
Yeah, Jackie, you can field this first one. Hi, Ed, Eric, and Jackie. Thanks for all your work. David Tepper came on CNBC last week and basically yelled to buy everything on China. I guess we can all take this one. Do you think sentiment and momentum on Chinese equities are real on a fundamental basis, or is this just kind of like a short-term melt up?
Well, we could have a vote here. Eric, what's your vote?
I think valuations were really depressed in China. Alibaba, comparable tech companies were trading at like 8 to 10 times earnings. And these companies are like pretty healthy in terms of their balance sheets. They have a lot of cash, they have pretty good earnings. So a bounce was to be expected. I think, as Jackie said, we're not too sure how long lasting this rally will be.
Jackie, you want to pitch in?
Sure. Um, I think consumer spending could pick up in China, but I think that the play on the developers, I'd be a little scared of that because of all the debt that they still have to restructure.
Yeah, I'm thinking more about the long-term macroeconomic environment, and I think the underlying geriatric demographic profile is just not something that they are going to be able to stimulate their way out of. I mean, it's conceivable that they'll achieve sort of a Japanese solution, which is, you know, a rapidly aging population and using technology to increase productivity. So it's it's impressive what they've done. The market's impressed, and we've had previous examples of we'll do whatever it takes, and they were sustainably bullish. So I wouldn't dismiss the possibility that that's the case here. But nevertheless, we'd still prefer overweighting the U.S. Relative to even China at this point. At least I would. Eric, go on for the next one.
Yeah, we'll jump around a little bit. Ed, how are sentiment indicators looking? Is positioning too crowded again, or is nothing looking too stretched quite yet?
Well, we're sort of in an environment of future shock with where everything gets discounted very, very rapidly. We had that carry trade sell-off at the beginning of August and another carry trade sell-off in the beginning of September, and they lasted what, Eric, about a day or two. And you would think that in the old days that might have created something really to be concerned about, but the unwinding occurred pretty rapidly, and the markets proved to be remarkably liquid. And maybe that's the key here is there's just so much liquidity sloshing around in the system. The thing that blows my mind is how far the stock market has gone into record high territory with money market mutual funds at an all-time record high. I mean, people are still pouring money into money market mutual funds. I think maybe this past week they came down a bit, but the week before they rose to an all-time record high. So there's a lot of money sloshing around, and that means things seem to move a lot more rapidly. It also means that it's hard to really get a significant sell-off, as we saw during the carry trade sell-offs. They were pretty vicious, but they didn't last very long, and they turned out to be great buying opportunities. But you had to be quick on your feet in order to take advantage of them. And I think we're now with the Chinese central bank pumping liquidity in, with the ECB doing the same, and with the Fed, we're back to an environment where the central banks are all got this fire hose going, just providing an enormous amount of liquidity, and that probably will keep things going here. But yeah, I think we're still going to be watching sentiment indicators because they are good contrary indicators, and maybe even on a short-term basis. And I could see the bull bear ratio was just soaring back over 3, maybe getting close to 4, and then it's kind of signaling another short-term trading opportunity. But that's about what we've been getting out of these things.
All right. This one's from Ted. So the election impact is high on worries for the coming year. Broadly speaking, can you lay out the pros and cons economically, should either party win the White House?
Well, I think our position has been that we think, and we're betting on gridlock winning, that whoever winds up in the White House, they're still going to have to deal with a Congress that's not totally friendly. The opposition party will be in one or the other houses, maybe even both, but I think at this point, one or the other. That being the case, we'll have to just see how things work out. I mean, it's hard to prejudge it, but we'll have more to say once we all know exactly what the makeup is of the White House and the two the two houses in Congress, the Senate and the House, I should say. Um, but all in all, the market has demonstrated an amazing resilience along with the economy. It's done well despite Washington. Both have done well despite Washington, and that would still be our bet.
All right, there's two questions on this topic, and then we could probably wrap it up. I guess like what level of valuations would we be concerned about, and to what degree do we feel that multiples are kind of driving the current rally as opposed to earnings?
Well, it has been to a large extent valuation driven, but earnings have done pretty well. Forward earnings all-time record high. We know that things like the Buffett ratio and is at an all-time record high. We know that the forward PE, I guess, must be around 22 right now. So it's still a little lower than what we had during the tech bubble at 25, but it's getting a bit stretched. We know that technology and communication services account for something like 40% of the market cap of the S&P 500. So a lot of valuation metrics suggest the market's not cheap. But we do think that the economy is going to perform well and that earnings are going to be driving the market higher. And it certainly looks as though technology will continue to excite investors with regards to things like artificial intelligence. Eric, one thing we should wrap up with is the port strike. It's apparently going to be, it may happen tonight. We'll see how that goes. Biden said he's not going to intervene and he's going to let collective bargaining play out. So that could be disruptive for a week or two, but we're not really factoring that into our macroeconomic thinking or stock market thinking. Eric, thanks for joining as always. Jackie, thanks for joining as well, and we'll have you on more often. It's always fun to have a little session, a little panel among ourselves. Thanks everybody for tuning in, and we'll see you all next week. Have a good week.
Thanks, everyone. Good luck.
Bye.